My name is Dan Gray, and I'm the research lead at Odin. While Going Solo is usually filmed in the studio in London with Paddy, in these episodes I'm taking the conversations online to meet emerging managers from around the world. The first conversation is with Arian Ghashghai. He's the GP at Earthling. I hope you enjoy. Arian, thank you for joining me. It's a pleasure as always.
Yeah, thanks for having me. I mean, I love to talk to you anytime, any place. So happy to do this.
To give like a rapid intro, you're a GP of a $5 million fund you raised in 2023 called Earthling. And you back weird stuff. Is that a good summary?
It's a good summary. The only detail I'd say we closed in 24, but yeah, I think that's exactly right. Weird stuff on the fringe and early. So, I think like the fund strategy is very centered up being like first, maybe second check. It's where most bulk of the investing has been. So weird and early, yes.
Nice. That's what we like to see.
Yeah.
You wrote something interesting in I think it was either in 23 or 24 about the raise, and you described the process of like being in like the really frosty, difficult market at the time, becoming like a cockroach and really testing the limits of the like venture ecosystem with your raise.
Yep.
Like I'm curious, like how was that process? Like what were the limits? What did you find?
So I think like this feels like it like forever ago now, but I think the reality was that at least at the time, 23 and I think 24 was some of the worst years ever for like venture fundraising, and particularly for new emerging managers. It was just bad. And I think even I always draw a bit of a line between like emerging manager and new manager when it comes to fundraising. Like I think they're common issues, but there are also a lot of differences, I think. So obviously I was a new manager at the time. So I think my issue was the following is that I think in many ways I hit none of the kind of traditional marks that LPs, particularly at that time, were looking for. And so by LPs, of course, here, I mean kind of the more established LP base, so kind of maybe the more prominent family offices with big portfolios, the fund of funds, right? I would say anybody that's managing money that has a very dedicated venture strategy and also a fairly large portfolio of venture funds and established history investing in venture funds, which was that, okay, I have no professional venture experience prior to doing this. So I was an operator, did angel investing, and that's where kind of a lot of my, founder investor side network was built over a few years. I was investing in a weird strategy that nobody wanted to touch. So, it was a lot about like the future of computing. I explicitly mentioned VR. Nobody wanted to even touch that, like this kind of stuff. So it was a bit of a wonky strategy. So no experience, professional experience, wonky strategy. And then I also just like pursued a portfolio strategy that was inherently popular, being very diversified. And so basically I kind of did everything like textbook wrong from the standpoint of like the starting parameters of making yourself legible to LPs, right? So by virtue of that, I learned pretty quickly that like, yeah, at least at this point in time, this is not really going to appeal to like the kind of conventional LPs that about the ecosystem that might back emerging managers. Well, like everything's wrong about it. And I think this was also a time in particular where I think everybody was having a hard time other than like the kind of big fund spin-outs. I think that was like something that time that was universally true. I feel like, again, I'm not actively fundraising, but my impression is that that's loosened a little bit. Like, there's not as much of a dichotomy anymore, but at the time it was definitely very true. To the extent that even LPs tell me like, certain fund of funds tell me that like, oh, we'll consider your fund if we don't get into this like X brand name guy that's spinning out from some like known firm or something, right? Like that's literally what they like tell you. So, that was kind of like the market at the time.
Do you think being weird like helped you find LPs that perhaps weren't as exposed to the downturn and were therefore a bit more willing to commit?
Yeah, so what we definitely found, and I think those people are coming a little bit more out of the woodworks now, which again, I kind of thank like you and Peter Walker and some of these guys for I think like giving people the courage to talk about these things. But, I think that what I definitely found was that there is an LP archetype that exists that actually likes what I'm doing. And they kind of tend to be, I would say, largely in two buckets. So I would say they're predominantly individuals or smaller family offices. I think in other terms where there's a bit of like a sole decision maker and there's not a lot of like kind of like broader IC consensus needed to invest. So like my acres of fund of funds allocated one where It's a fund of funds, but, I think in a very practical sense, there's one decision maker there, on that committee, and he basically does whatever he wants, right? It's kind of like my understanding. I think that's one of the reasons, like, that this kind of worked out for me. But all the other LPs are kind of the same. And what you basically notice is that they kind of tend to fall into archetypes. Like they tend to fall into the archetypes of they're very new to venture. They've decided they want to invest in venture. They haven't done a lot. And like those are people, particularly ones that have like mundane professional backgrounds and trying to get into venture, they really actually like gravitate towards the like super wonky, like weird stuff because it's such a contrast to their day life that they actually like it. So, like you talk like people like, that work in the government or like they're dentists or something like that, right? They're really into this like, whoa, crazy stuff. We love them, right? Like futuristic, like they tend to. Then the other ones that like, are on the other extreme end of the barbell where they're like, yeah, I've invested in like 200 funds and all the ones that have made me money are the ones that were like weird guys doing weird things on the fringe at some point with some modern tech, and they invest in a lot of companies and it just works, right? So then there's like those kinds of archetypes, right? Where they just say like, we've just invested in so many different kinds of funds. This is just what we see what actually works, right? Which to me was actually very validating that the super experienced LPs are the ones that were actually also kind of like into this kind of strategy. Like I even have one LP, he straight up told me, he goes like, I don't understand what you're doing, but the parameters of it are like enough in range that it makes sense for me as something that could make money if someone to give you money, right? Because I've invested in like 100 funds. And so it's everything in the middle that didn't really pan out, I would say. But that's where I did sort of find my audience. I think at the end, it made it a bit easier because you kind of knew what kind of LP profiles you're more or less looking for and like who it would resonate with. The other interesting thing that I heard, by the way, which I think is sort of worth calling out, sort of on the flip side of that, is that they would also say, I've not been pitched a lot of these kind of funds lately. And so it actually made my sale infinitely easier when I met these people. Because they were like, we actually love this. Like, again, we think this is what works, but nobody wants to pitch it anymore. And I think the reason for that being the case is, you and I both know the reason, which is, of course, there's a lot of incentive from the established LPs to do the opposite. But I thought that was really interesting. And so there are definitely calls I got onto LPs that I met where I was like, I think this is going to be an easy sell, just based on what they're telling me of what they're looking for. A lot of those panned out.
So you think it probably would have been a harder time raising if you'd gone with like a vanilla 25 companies, mostly software kind of strategy?
So when I started raising, so I was at Meta before, and I was like a machine learning engineer at Meta. So, I'm kind of like a bona fide AI guy coming from like a blue chip background, so to speak. And so actually the question I got at the time was twofold. One was, why don't you start an AI company? Because you could raise like the $5 million to try to raise for the fund, you could raise much easier than you could than if you were doing it for a startup. And the other question I think was, why not lean a little bit more into AI? I do know peers that did this, so I do assume that this would have probably worked better. Is if I would have pitched them the idea of, okay, I get AI, like I worked in natural language, LLM, which I did, like LLMs are all natural language stuff. This is where I come from. I have this background. I'm just going to basically give you like an access portfolio of like the 15 to 20 best breakout AI companies, early stage. That's what you're going to get. I'm sure I could have raised way more money, like way more. I just I never felt that that's something I wanted to do or a game I wanted to play. And I think more importantly, not something that I think would actually make a lot of money, other than I would make more management fee. But ultimately, like, I don't really think the point of doing this is to try to get rich off the fee, right? At least that's maybe I'm too idealistic about it, but I still like to think that my own wealth should be determined by how much money I return to investors. So it never made sense to me because, again, I was like, obviously it's going to be hot. Obviously it's going to be competitive. I have no idea how it would articulate some kind of like lasting compounding value here, like on a firm level. Because, I want to do this for, like I'd be getting into this for doing this for, 15, 20, maybe more than that years, right? And so that felt like a good flash in the pan strategy, but not a good sustainable firm strategy. And again, for me also, this is like fun. And it's just, I think like trying to compete for the hottest girl in town is just not a fun game to play for me anyway. So I never even gave it consideration, to be honest, but a lot of people did that. Because I think a lot of people were in my position, right? For the most part, that like, you want to raise a new fund. It's really freaking hard. how do you convince people to give you money? It's to pitch them a strategy about the hot thing that everybody wants allocation to, which like, has been AI. And you're going to sell them some narrative about how you're going to get them to all these great positions. And you and I both know how that will put a bunch of managers into a pretty big pickle in terms of what they have to do, which is either face scrutiny from their LPs for not investing in something or overpay for something, right?
Yeah.
Which is a lot of what's happening. And so like how that ends well in either case, I don't know, but I think that's like functionally the pickle that a lot of people are in.
It's a repeated cycle in venture. I'm surprised more people don't understand this or apply this, but every time there's a surge of interest in the market and a wave of capital that enters VC, it ends up going towards like the currently understood opportunity rather than diversifying what gets funded, and that just competes away returns.
100%. I'm in two minds about this, right? Because on one hand, I think it's easy to blame the manager for it and to be like, they're pitching a product that is inherently unlikely to make money. It will be easy to raise for it. I could totally see how you can get very easily incentivized to be like, I am going to do something that is easier to raise for, just so effectively I'm less miserable, right? For the lack of a better term. Like, I do understand that. On the flip side, I'm also like, well, in the end of the day, they're also raising money because really what you can kind of look at what we do is we offer financial products that LPs want, right? And LPs buy them. And so like largely, the financial products that are offered by venture capitalists are like, so the VC products that exist are largely tailored to LP demands, right? Because ultimately that's what we're doing. Like we're really just middlemen between how they want to allocate their capital and then, kind of the end asset that we end up allocating to. Like functionally, that's what we do. I like to think that in the end of the day, like some, an LP is giving me money because they trust my judgment to make them money in some kind of way. And so it should also equally be my responsibility to push back on an idea that they might have that I think is not in their financial interest to pursue. But I do understand that the sort of line of logic as well. They'll be like, well, they've already independently made that decision that they're going to allocate that money. So if they're not going to allocate it to me, they're going to allocate it to somebody else, right? So I might as well give them an outlet, like a vehicle for it. I don't know. I think it's actually a hard problem, but I think that's all to say that like I don't necessarily absolve like LPs of responsibility about a lot of this like ridiculous behavior.
It's an interesting thought experiment to think about the mirror between that and the founder GP relationship or the founder VC relationship, because you have a similar problem.
Yep.
Where founders know that VCs want to invest in something and they will go out, and the more opportunistic mercenary founders will build those companies to get investment. And how often do those turn it into like generationally great outcomes? Maybe sometimes, but I don't think it's really what drives the success in venture.
I don't think it does either. I mean, like, it's funny you mentioned that example because first of all, I think it's very analogous. Like, I actually think that the LP GP relationship is very analogous to the VC founder one. But to your point, I mean, like I started talking about this to people recently about robotics, right? Because, I've been investing in robotics basically since I started this fund. And, I think investing in robotics 2 years ago, before it kind of got, I would say it's firmly consensus now in many ways. I would say that it's consensus with a caveat. But back then it was still pretty kind of like the idea of investing in hardware even 2 years ago was a bit like, what are you doing, right? Like, it's like too... it's weird, right? Kind of thing, like unjustifiable, whatever. That's obviously changed. Now you have a lot more to choose from. Like the absolute volume of robotics companies is, in my opinion, like orders of magnitude higher than it was because it's attracted a lot of venture dollars. And so of course you have like less of the kind of like idiosyncratic, like strong fit founders. You have a lot of like, I don't necessarily want to call them grifters, but I could definitely call them opportunists in terms of trying to take advantage of the heat in that industry. And you're actually seeing a lot less ideas. And so like I would say the actual I'm seeing less original ideas today than I did 2 years ago. And that's because I think like in robotics, for example, the capital is really concentrated around 3 ideas within robotics, right? For me, it's like general purpose robotics, anything related to trading, and the robot brain problem, basically. So everything out of that is still kind of like non-consensus. You still have a lot of that kind of, the old dynamics still kind of exist for sure. But what you're seeing is that, in my opinion, you're seeing a lot of roboticists that actually know better are building these kinds of companies because they're very incentivized by the capital market to do so. It's an unfortunate, I think, byproduct of excess demand for things, right? So,
and I think a poorly understood bias where you'll find if you promise someone like a huge financial reward for doing something, they may not believe it initially, but the more they like can taste that reward, they will actually start to believe it eventually over time.
I think, Dan, I think that's like the biggest problem in venture right now as a whole, right? Like, at least for me, like, this is the thing I think you and I both like run our heads through the wall about this kind of stuff, right? That there are myths that exist about like company building. And I would say company building, particularly within the context, obviously, of being a venture-backed business, that I think are mythical. There's no empirical evidence for it whatsoever, but it's just like commonly accepted as facts, right? And I mean, like the ones that you and I harp on a lot, for example, that like there seems to be this belief that you can like predetermine outcomes more reliably based on like, inception stage input parameters to that company, be it like founder credentials or whatever, right? Like the idea that more money raised equals more likely successful outcome, like that's obviously not true. There's a consensus myth that gets built up by somebody, perpetuated, and there's nothing you can do to refute it because it's, there's so much anecdotal belief that this is correct that, people just fall in line with it. And like, you see that at company level, you see that obviously at fund kind of GP level. It's annoying to say the least.
That's a good way to put it. I think that there's like a simple way I think about this, which is like essentially venture capital is a game of outliers. Greatness is completely idiosyncratic.
Yeah.
No two successes look the same, so there's very little you can learn from one to the next. But for all that sounds simple, it's incredibly complicated then to communicate to anyone else why you invest in what you do or like what the opportunity is. It becomes really hard. Those are the information frictions that like scaled venture capital is trying to get over with the simple ideas.
Yep.
Of like the very easy to sell stuff, like if a founder went to X university, they're going to do well. If they had a previous exit, they're going to do well. Some of these have statistical merit. Most of them don't. But it just creates this whole like simulation of venture capital where it's way easier to raise money. It's a much easier story to sell because the alternative is to say, well, if idiosyncrasy is the goal, then like the best manager is a like eccentric solo GP investing in crazy stuff. But that doesn't scale.
It doesn't scale. Inherently, every organization's goal is to grow bigger and bigger and bigger. I think obviously a lot of organizations have the idea of just growing the same kind of principal vehicle bigger and bigger and bigger. And so I agree, like you have a scaling problem, right? Because inherently these kinds of like idiosyncratic strategies top out at a certain size. The other thing is, something a GP told me that's been very successful doing this for a very long time. Basically it was like, listen, like the best way to make money is to just like find overlooked, undervalued markets and invest in that. And like, and basically you end up being right? And like, that's really where your big returns come from. Now, the problem is by assuming that the best opportunities are in undervalued, overlooked markets, it directly implies that there's very little financial interest in those markets. So by definition, it's actually hard to raise for them, even though they end up being the best strategies over and over again. And it's like very, very difficult to put some kind of like very tangible, coherent thread through like what that actually means, right? Especially to somebody that's not on the ground doing it. It's a hard sell, right? And it will always be a hard sell. And so I think, first of all, to do it, you have to really be doing it for the love of the game. Otherwise, there's like a very there's very sadistic exercise to some extent to just raise money for this continuously. The flip side to that is like, that's why I think a lot of these funds, like a lot of managers come up with these kind of like very polished narratives as to like what they do and what they're selling you. And they start to some extent believe their own hubris about it, right? Like, and, they ultimately sell that, right? And so I think that's where you get into this whole kind of like picker myths thing, right? Which I always also find quite annoying. That sure, there are some venture investors out there that I agree they tend to have a very, very good nose for, having very good taste in picking founders that'll be successful. Sure, most don't. But you have to sell everybody this like hubris on like, I can foretell the future about this like one founder that doesn't even have a company yet, and he's sort of like, there's so much variability in outcome, it doesn't matter. Like I don't really, so much can go wrong that you can't account for. Like I don't know how somebody can actually with a straight face make that assessment. But unfortunately, like this is the only stuff you can sell to LPs. I mean, it's like, again, within the context of, I mean, I think venture capital is chaos. Like early stage VC is completely chaotic. It's one of the only narratives that you can really craft in a chaotic environment. Well, the problem is a lot of GPs start to actually, I think, believe their own hubris, right? And like that's the problem.
I give a huge amount of credit to Chris Sacca. Chris Sacca, obviously, like first low case fund, incredible success, like huge outlier. And he could have said, like, this was like purely my picking skill. I can keep doing this forever. And he could have kept raising like bags and bags of money. But he said, actually, this was kind of a product of my relationships at the time, where I was in the tech industry, my experience, and like, it's not something I can keep reproducing. So he changed strategy and like has gone on to great success elsewhere as well. But like, I love that he had the self-awareness. If you were in the LP seat and you were trying to find like a real missionary fund one manager, like what do you look for? How do you separate them?
What I think, for example, worked for me was that my thesis pitch, because, a lot of it was centered around like, future of computing, right? And, it's like VR and robotics and hardware and all these kinds of things. These are all things that I worked on for a long time, right? So I think one of the things that like I never really had a lot of questions about was like, are you a credible person to try to pursue this thesis? And I think it's less, in my opinion, it's less about, do you know what you're talking about, but more like this absolute commitment to like a certain strategy. And I think particularly in the context of, you're literally just doing something that you have track record of believing in, not something that seems to be swayed by outside opinion. I'll give you an example, actually, of like somebody I would invest in as an LP, is Mike from Also Capital. And so what I think is interesting about him is I actually disagree on a lot of what his public strategy has been, right? In terms of like, he's like very obviously into concentration and this kind of stuff. It's obviously extraordinary in many ways, so I think that goes without saying. Like his amazing track record, people love him. I think he's one of the few like early managers that I've met, even talking to other founders, that I think has this kind of like cachet to demand that kind of allocation amount for like a newer manager, which is extraordinary of itself. But he's so convicted by it. When I talk to him, he'd be so convincing about why he's doing this. And you can really tell that it's like he genuinely believes it, right? He's not doing it because the LP tells him to do it. Like he just genuinely believes this, where I'm like, it's a combination, like clearly you're great. Clearly you're very convicted by what you're doing and why you're doing it. I don't even agree with it, but there's a chance it might work. And so I'd like take a shot, right? So he'd be an example of somebody where even though I disagree with him, I think some of the primitives are there to make me believe that he'll actually do well. And so generally I wouldn't really be focused on like, do I believe in the sector? Do I not believe in the sector per se so much, or like even the strategy? I would look more at the manager and be like, is this a person that feels to be completely self-convicted in what they're doing, where they're just like wholly unswayed by what's going on around them? Like they're just kind of playing their own music the whole time and like whatever it may be. And so I think they're in a combination of like, that parameter is true about them, that they're really just kind of in their own orbit and they're kind of just on their own conviction. Either they're the ones that are influencing other people, or they're just like kind of unswayed by noise around them. And then they have some sort of base credibility being able to kind of perform whatever their strategy is. I have reason to believe that they could do that. For me, that'd be enough, to be honest, to be like, if I was building a portfolio of funds, like those are the kind of people I would look for. I think the biggest thing in there is just like, that I would feel confident that they're 100% going to be driven by their own independent thoughts. Whatever that thought may be, I might even think it's wrong, right? But that's actually part of venture. Like I fully accept that like I might have ideas about a market or a strategy or whatever that might prove to be incorrect, right? And so I wouldn't even have a problem betting on somebody that believes some things that I don't believe in, as long as that core primitive is true, is that like he's independently minded about it. He has a lot of good justification for why he thinks that. For me, that'd be like, hey, this is exactly the kind of thing a venture bet is, right? Like, is exactly betting on a person with that kind of mentality.
Exactly. I was going to say, like, going back to the parallel between the two, like, interfaces, that's another example where, like, it's the same problem. Yep. You're looking for the same thing.
Totally.
Looking for the person who has, like, conviction, especially, like, someone in your case who could have raised the AI fund but chose to do something else. Like, to me, that would be very high signal. Or if
Yeah.
it was a founder and they like had spun out of doing AI work at one of the labs, but they weren't doing AI, again, like that would be very high signal.
Totally. Yeah, I think a lot of it's also understanding that, like, and I think this gets lost, right? Sort of in this world now where everything is about consensus and about consensus this and consensus that and whatever. And you should only invest in things that are legible, everybody agrees on, and blah blah blah. I think the beauty of venture is that you're going to have a lot of people that hold unconventional beliefs that end up being correct. That, if you're invested in them either by virtue of a fund or a company, will make you a lot of money. Now, of course, a lot of times they might also be wrong, but a lot of times they're going to be, there are going to be a lot of instances where they're correct. And I feel like your entire strategies and allocators should be banking on that idea, right? That like, hey, I'm only going to get an asymmetric outcome if I bet on somebody that's doing something with high conviction that is not consensus. And I might even disagree, right? But if I have reason to believe that like this person is highly convicted, they're very credible in that belief, and I can get behind them and I can see their logic and they seem to be good at executing, maybe I should give them money, right? And some of them will pan out, some of them won't, but I think that's exactly the point of venture, right? Whereas like I think not the point of venture is to just be like, let me just pile on to everything that everybody else is doing. I have no idea when in history that was like something that really drove outsized returns. I really don't. Maybe you do. I mean, you're more like historically savvy on data and all of that than I am, but it first of all, it doesn't make any sense given the risk profile of this. And like the second thing is like, I can't think of things. I mean, I think any kind of legendary investor you talk to, they have some narrative of like their big win was some like weird limb they went out on against everybody else and ended up being right? Like I think almost every big investor has some sort of story like that. And so I'm just like, I don't know why we poo-poo this idea that all of a sudden this is not true anymore. Like it doesn't make any sense to me. I don't know. I don't get it, right?
There are positive consequences to hype to the extent that, like, as has been talked about kind of ad nauseum, like bubbles can have positive outcomes. Like positive outcome of the .com bubble was like fiber installation everywhere, etc. Everybody knows. So another similar example that's interesting is like the like early 2000s, the Kleiner Perkins clean tech investments in the early 2000s. It was like a real mismatch with the structure of venture. The investments just didn't really work out. And certainly Kleiner didn't benefit. Very few people did.
Yeah.
But actually over time, like it did help drive down the cost of these technologies. It helped drive a lot of R&D, had a lot of positive consequences, just not for venture capital. And like that's maybe the case most of the time with these things.
I suspect that is probably what will happen now anyway. In terms, I think we're firmly in a bubble. Like I'm not at this point, I'm not even disputing that. I mean, I think from an early stage venture perspective, even just if we consider 21 a bubble, and I like vividly remember how 21 was, I don't think we're far away from, if not surpassing the level of craziness that exists in 21. I think for me, the difference is that now it seems that maybe not as many companies in absolute number are getting funded, but the ones that are getting funded stupidly, which I think structurally ended up amounting to the same thing to some extent. I definitely think so. I mean, listen, like I think, investing is obviously a lot about like, putting the adequate amount of resource behind something given the kind of projected future timeframes of that to return money. And I think it's fair to say that a lot of people get mad at me because I'm like, how can you doubt AI and this? I'm like, I don't. I think it's a remarkable technology that will have a lot of, like significantly reshaped society, like no doubt about it. Highly consequential, highly valuable. But, but that doesn't mean that you can just dump an infinite amount of cash in it and it makes sense as an investment, right? Like, I think that's the equation a lot of people are not understanding. I think it's also this almost just all or nothing mentality now, where it's really like this just genuine belief of like, there are tech companies that matter. Everything else sucks, right? Like it's not going to make money. There's actually like very uniformed idea of how to make money in venture capital. And again, I think this is something else I think you and I have talked about before where, where in practice, actually the term venture capital in of itself doesn't really mean anything anymore because it's effectively multiple different industries operating at different layers of it, right? But it's all kind of being reduced down into being venture capital. But, it's like, if I try to invest the way Andreessen Horowitz invests, for example, I will not make money. And that doesn't mean Andreessen Horowitz won't make money doing it. It just means I won't make money doing it, right? And vice versa. Like if Andreessen Horowitz does what I'm trying to do, they will also probably not make money, right? That doesn't mean that I will make money. It just means is that like we fundamentally have different capital pools that require different strategies, and everything you kind of extrapolate from that. Yes, it is probably true that for Andreessen Horowitz or Sequoia or General Catalyst or these funds, yes, like those kind of companies, like those kind of limited exit opportunities might actually be true, right? Like entirely possible. Given just mathematically the scale of exit that these companies need, right? Like it's very, very small sliver. But like if you're running a $20 million seed fund, like you have a completely different real estate to go invest into and make money from. And like this is the part I don't understand, that people like cannot wrap their heads around it. I become very bearish on a seed fund manager that talks of this like, my only way of survival is by figuring out how I basically get into their food chain. I'm like, that's not gonna last, right? Like maybe you have one good fund, but I have no idea how you're gonna build a firm around the idea of being like a quote unquote access fund for like these big funds where like, they like you enough so they cut in for like 100K in one of the rounds or whatever, right? Like don't see how that works. Anyway, end of rant, but like this kind of stuff just drives me crazy. It really does.
It's funny how much all of this connects, because I think there is like, again, it's like the similarities between the LP and the GP and the GP and the founder. Like if you look at this problem particularly, you could say, let's say 2019 to 21 particularly, there was kind of a bifurcation in the LP market with the entry of like sovereign wealth, larger institutions looking for places to put money.
Totally.
That bifurcation exacerbated or somehow created a bifurcation in the VC market with the mega funds.
Yep.
That became a very defined separate strategy.
Yep.
And like there's all kinds of problems there about how slowly that developed and how it took a while for, and even still today, they don't really understand. Like a lot of GPs don't understand they're two very distinct strategies and you have to know which one you're doing because you can't be in between.
Yep.
But then that has created a bifurcation of the startups at the level below. And that I don't think is very well understood, because I think there is an idea that if you're a venture-backed company, you now have to shoot for like a $50 billion exit to be meaningful. You have to be one of the companies that matter. And it's nonsense. If you raise from a small fund, if you have a trajectory towards a reasonable exit, that can be awesome for everybody. And it's great for the founder as well as an outcome to like propel that company.
Yeah. I was talking to a GP the other day that was telling me about a deal that he did a few years ago out of 4 posts from this founder. And so this founder never managed to raise money again. But they grew quickly and they grew profitable. They just started growing up profits. So like the only venture money they raised was either just from him or that round in any case. And they ended up selling the company for like $250 million. And that GP was somehow he basically returned his fund off that investment, right? And I'm like, that's amazing, but that's also like a story that you'll never ever hear about, right? Because like a $250 million exit in M&A terms is effectively negligible, right? Like it's not a big deal. I think one of the things that I'm very sold on is that for us seed fund, pre-seed fund, small fund managers, I actually think the exits in net value in terms of what we get back on return on investment are actually going to be higher and higher and higher. I think that's not just a product of, that same VenCap graph I was talking about. What you actually see is that like consistently every 5-year bucket, the evaluation of the 10th percentile and the kind of top percentile basically almost like increased 2x like every 5-year bucket, right? So like the exits obviously get bigger. That's one thing. But the other thing is that I actually think a lot of these companies are going to take less dilution. And, I think I'm already seeing that in some of my portfolio stuff, that either they're like completely foregoing trying to raise more money because, again, like of this whole bifurcation you're talking about, or, they get quick traction. They probably skip what would have been a more maybe like middle of the ground seed round, something that's more akin actually to kind of like a Series A. They're raising on safes longer, right? Which, of course, for early investors can be beneficial because they're just dilution we don't eat. And like these things will actually add up to the point that like, there's so much structural pressure in place, I think, because of all this capital that's being allocated to these like very kind of $50 billion plus ideas. The allocators that are like, we can be happy with a $1 billion, even maybe like I have positions where like they can exit for a few $100 million return on the fund, right? They have set up, basically have a setup to do those kind of deals. We're probably actually going to see more net dollars returned on exits there because I just suspect we'll get diluted less, basically, for the lack of a better term, right? And so I think there are actually more profits to flow into people that are willing to bet against sure, this $50 billion sub great, it is necessary, there's a place for it. But that doesn't mean that all these other companies that can still be quite large and drive good returns are all chopped liver. If I was a founder, by the way, to sort of take a bit of a tangent on that point, if I was going on Twitter and seeing all these VCs, seed stage VCs talk about like 10 companies matter, if you're not going for 50 billion, you're chopped liver, like you suck, blah, blah. I'm like, why would I want money from you? Because you're basically like almost like telling me that like, oh, because I'm not OpenAI, I'm like meaningless, or because I'm like not for a particular milieu that you like I'm going to suck, right? Like, why would I want your money? Like, if anything, I want my early investors to be like, go for it, very encouraging, obviously believe in the mission, believe in you. So I don't even understand what like the signaling strategy with some of the stuff is that VCs put out, because I'm like, I would imagine for me that it reflects more negatively with founders than anything, but which I feel like, again, like if you're not popular founder, like what have we been doing here?
It's almost like maybe they want to give money to founders that are very good at raising money and are driven by generating, huge valuations on something, on anything.
Yeah, I'm like flabbergasted, just like also because so much of it is like contradictory. I mean, like in terms of, you got like, these are also the same people that would advocate for the idea of like, you gotta invest in markets before they become hot and kind of be a bit of like, predict the market and get in early. And then they shit on like, well, if you invest in cheap deals, they're bad. And I'm like, I'm sorry, sir, but where do you think the cheap deals live, right? Like they live exactly in these like undervalued, like overlooked, maybe pre-consensus verticals where nobody wants to back them. Like that's where you find the deals that have doing really well that you get in cheaply, right? I really do think there are too many people running very nicely sized vehicles. By that, I mean, they're small funds, sub 100 million, that really feel incentivized to do the wrong thing. And I think that is a shame. I think largely for founders, I think like it's more than anything. It's, I think at the end of the day, sort of the closing thought here, I think it's important to I think remember that like the main players of this entire thing are founders. And we're just like support mechanisms at best, right? In terms of like helping enable these people make the future. And so kind of this idea that, VCs like assign themselves, this whole kind of like market making power, right? This like complete control over the future of innovation, I think in of itself is farcical. And so like ultimately what this all comes back down to, I think in terms of longevity, is like, having a reputation for enabling and helping and putting into business, founders are ultimately making a difference and pioneering important things. And I feel like a lot of VCs have lost touch with that reality, right? And that they think that their responsibility is actually a completely different one, but also that they're the main players, not founders.
I can tell you that like it's a core belief at Odin that big money should chase ideas, like rather than ideas chasing big money. Like that's the way around the market should work.
100%. I always like to think that I'm optimistic about like the future of venture and all this stuff. But having kind of sat through 21 and now sitting through this and seeing that there are like virtually no lessons learned, I'm not convinced we're going to get back to kind of like utopic venture stage. I think the problem is it's gotten too big, and as everybody knows, no organization ever seeks to downsize, right? So the question is like, how do you find like a healthy balance, and like, or like, what's the status quo going to be? And I think the current status quo foreseeably will be that there will always be bubbles. Like, I think by necessity now, given the amount of AUM and like all this stuff we talked about the size of exits that you need and all of that, how much money you need to put to work, you're going to have bubbles by definition. So I think, I'm already completely convinced that, we're in a kind of like AI-centric bubble now. I mean, which includes obviously kind of like, AI in the simple sense, but also robotics and stuff is the quote unquote physical AI piece, all kind of part of that. I'm already completely convinced that we could sit here in 3 years and talk about a space bubble. Completely certain that that's going to happen, because that's going to be the narrative about, well, AI didn't fulfill its promise because of infrastructural shortcomings, and we're going to fix this by putting everything in space. And it kind of will self-perpetuate itself that way. Now the question is ultimately, is that a market condition that LPs are happy with in perpetuity, where there's always a thing that they will put money into that will eat a lot of money? And it is correct that there are some elements, there are some entities, there are some companies that will be very successful, make a lot of money, right? Like that, I think, is obviously inherently true in any of these kind of environments. But, will LPs continue to have appetite for the same kind of cyclical bubble structure with the hope of reaping upside from some of the few success stories amongst all the burned down buildings along the way? Time will tell. But I think that's the current status quo. I think that we're very firmly in, and probably have been in for a couple cycles now, frankly. Founders in the fringe are always going to matter, right? Like there was even a point in time where doing AI was not super popular. Now it's the big thing, right? So once upon a time, there were managers who were putting money into probably companies that were like preceding the OpenAIs and the Anthropics of the world now, that set up a lot of the environment that we could have today. We're going to need more of those people for future technology, right? They're going to have to be futurists. They're going to have to be allocators that are willing to take like long shot bets on these people, even if, again, like not all of them are going to win, obviously, but like kind of like what you mentioned about, like the climate tech, all this kind of stuff, that there are like positive reverberations for a future market from that were important. They're going to have to be allocators that continue to invest in that, because like if you cut that off, I think you basically put a chokehold on all future innovation. Like all these like future bubbles that might exist might cease to exist because there's nobody that's really funding the very, very early innings of that, right? For it to even get anywhere, to even get to a point where it could become a bubble, or it could become popular. And I think, unfortunately, we're in an environment where both, allocators on the LP side to some extent, and also GPs are becoming increasingly disincentivized to do that. And I think that's the kind of part of the whole thing that I'm a little bit more concerned about. It's that my head explodes when I see small seed fund managers go online and talk about how they should only invest in things that are capital legible. I'm like, what are we doing here? Like, that's not the point of this. Like, you don't run a $20 million fund, in my opinion, to invest in what Andreessen already does better than you. Like why? Like, why does this exist, right?
Yeah, it's, we've written about similar topics about like the casino economy, about the lack of like productive distribution of technology through the economy, to kind of loosely paraphrase Carlos Perez. Like it's a real problem. But I guess like maybe let's put a pin in it there. Maybe you and I can circle back on this in future, and like hopefully we have a more optimistic perspective.
I hope so. I really do.
All right. Well, perfect. Thank you for taking the time. It's been a real pleasure. And yeah, let's definitely do this again.
Definitely, Dan. It was great to talk to you. So, this was fun.
Likewise.